Good morning from London. I'm Kriti Gupta alongside Lizzy Bird, and we're an hour away from the opening trade. Here's what you need to know. The U.S. and Russia move to revive ties as Ukraine is left out of peace talks in Riyadh, raising the possibility of removing sanctions and increasing embassy staff. And another round of tariffs. President Trump said he would likely impose them on imports of autos, semiconductors, and pharmaceuticals as soon as April 2nd. Plus a slew of earnings and UK CPI crossing the wire. We will break down the numbers. Lizzy.
Well, Kriti, we are just waiting for those CPI numbers to drop out of the UK. The expectation that you're going to see a rise at the headline core and services levels. We await a reaction in the pound and to see how much it's going to really move the needle for the Bank of England. We've heard a lot from Andrew Bailey recently, kind of emphasising growth more than inflation, kind of echoing the ECB when it comes to that. So we are seeing, in fact, that CPI has gone up to 3% at the headline level. The expectation was for 2.8%, a beat there. Core 3.7% in line with expectations, and services actually below expectations, 5% below the expectation of 5.1%, but still an increase from the previous month. So let's look at the market reaction. We have the pound pretty steady, actually, a touch stronger at $1.26, but European futures flat to the downside as we await potentially a market reaction to Trump's renewed tariff threat on autos, pharma and semiconductors as well. And we have Brent trading at $76 a barrel, stronger 0.4% amid all this uncertainty around Russian oil flows given those talks in Riyadh. The countdown to the opening trade starts right now.
Good morning, everybody. Welcome to the opening trade. A lot to digest in the geopolitical space. We are, of course, seeing both talks in U.S. and Russia, the high-level talks, starting to yield some thaws in the relationship. At the same time, a summit coming from Emmanuel Macron and more European-focused leaders right here in Europe. That happening later today as well. But then in the meantime, as the markets wrap their head around the geopolitics, Lizzy was just talking about the CPI story. We've got plenty of earnings. Well, let's start with that UK data. Hotter than expected, limited market reaction.
Yeah, and I think that the limited market reaction, as I say, is because recently the Bank of England has been focusing on growth. Andrew Bailey, the governor, kind of echoing Catherine Mann, the arch-hawk-turned archdove, who voted for that jumbo cut because of her concerns about growth. Bailey saying that, you know, he doesn't need to reach the same conclusion when it comes to what to do about it, but this emphasis on growth nonetheless. So interesting to see these numbers on CPI this morning. Zoning in particular on services, actually a miss there. So perhaps that'll give a little comfort to the Bank of England when we get those updated bets later this hour.
Yeah, absolutely. The fact that you are seeing that services coming in a little bit weaker as well, but still 5% versus an expected reading of 5.1%. That gap isn't as big as we've seen in some of the European data as well, to your point. Let's talk about some of the other earnings that are hitting the wire. I'm going to kick it off with BAE there because, of course, the defense sector very much in focus. Yeah,
and of course we've seen gains for defence stocks in recent days. So BAE Systems raising its semi-annual dividend 11% to 20 pence per share. Really interesting in light of this push for Europe to spend more on its own defence. And even before this week's events, Kriti, BAE was expected to have a solid 2024 because of this growing defence spending in the US and Europe. So BAE results coming through there. They see sales of 7 to 9% for 2025.
And raising their dividend as well, which is a theme we've seen across the corporate space on both sides of the English Channel. Let's talk about Glencore as well, because you are getting numbers there. A similar theme, $2.2 billion worth of shareholder returns. That's the plan coming out of Glencore. Their share buyback of up to $1 billion. When you look at the earnings itself, a little bit of a mixed bag. And this is important because we are getting some kind of higher slight beats in that full year revenue. They are still highlighting a level of caution as well. So that's going to be something to keep in mind as we talk about some of the other moves. But really, that share buyback is the juiciest bit.
Yeah, $1 billion there. Really interesting in light of the BHP results as well, slumping on the China weakness. It'd be interesting to get under the hood of those Glencore results later in the programme. We've also earlier today had the HSBC earnings, speaking of the Asia impact, a beat on pre-tax profit, a $2 billion share buyback there. The share's up in Hong Kong, but no clarity so far as to what they're planning to do on the Mexico business. which is interesting given, HSBC is the 5th largest bank there, and one of your pet interests, Santander, of course, aiming to double its size in Mexico. So, what is HSBC going to do about that in the light of the tariff threat?
Yeah, absolutely. The story there is fascinating. And of course, that does come down to friendshoring and manufacturing. We know this is an Asia-based bank at the end of the day. Some of that's happening right there in their backyard, Vietnam, Cambodia, et cetera. The headcount story, I think, is interesting out of HSBC. CEO talking about a headcount reduction of less than 8%. Now, you do see the market reaction off this be a little bit different, and that sometimes is viewed as a positive due to efficiency, sometimes due to a negative, highlighting the crunch there. We'll see how that all shakes out at the opening trade. Of course, the other piece of this is the tariff threat. We keep hearing it over and over again. Several sectors in focus: autos, semiconductors, pharmaceuticals. We've heard this story before. Is a delay to April 2nd a positive or a negative for these sectors?
Yeah, and also, is this just a negotiating ploy, or are we actually going to see implementation after April the 2nd? Is Trump actually going to give some exceptions for certain nations? I'm sure Germany will be hoping so when it comes to autos. Is he conscious enough of the inflationary impact that actually his bark is better than his... Not as bad as his bite.
There you go. This is interesting because Tom was talking about this in the last hour as well. That, of course, you mentioned the Germany piece. That's where you have the biggest imports as well. But even for pharmaceuticals, Novo Nordisk is going to be really much in focus. Morgan Stanley had a great analysis. 60% of that revenue from Novo Nordisk comes straight from the United States. So that import story, the Wegovy, et cetera, is going to show up there as well. It also has a read-through into their GDP. And that's something where you start to look at the earnings getting married with some of the geopolitics as well. We know the United States and Denmark aren't exactly on the best footing right now.
Now, the other question that we've been asking ourselves is whether Donald Trump is going to give a little on tariffs if Europe gives a little on defence, which takes us to this 4-hour meeting in Riyadh of such historic significance. I thought there was a really interesting quote from a former US ambassador to Russia saying that the Russians were in Riyadh to improve US-Russia relations. The Americans were in Riyadh to talk about an end to the war. And those are two very, very different objectives.
They absolutely are. I mean, economics at the heart of this as well. And it's not a secret that this is happening without Ukraine's Vladimir Zelensky at the table or any European leaders as well. This is crucial because at the same time that these conversations in Riyadh are happening, you are seeing a second summit in Paris due to come today as well. The first summit not really yielding that much, besides perhaps a little bit more friendliness around the idea of joint debt issuance. But the timeline here that folks are talking about when it comes to the U.S. and Russia versus the Europeans are completely different. I thought it was interesting. We're talking here about potentially removing sanctions, potentially talking about getting embassy staff back in office as well. Those are two very big pro-diplomatic Russia moves.
Yeah, and Trump saying that Ukraine should have elections. There's pretty much no other way of seeing that than a personal attack on Vladimir Zelensky. So you have to ask whether Trump is going to try to settle the Ukraine war without Kyiv on Putin's terms. That is the worry here. We don't have a date for the Trump-Putin summit, but Trump says that it'll be probably before the end of the month.
Yeah.
That's next week, isn't it? It's like in a week. And a Russian official saying that is not going to happen. So a big gap there still.
Well, that is certainly something that has been under quite a bit of contention, and simply that we know that because of the war effort, those elections have been postponed. But any Democratic leader will say that, of course, a democracy is a key piece of that. Does that fall under exception in a wartime emergency? We know, especially as exceptions seem to be something that the United States is using quite a bit in terms of emergency declarations, et cetera. Does that apply to Ukraine as well?
Exactly. And the war in Ukraine, of course, a crucial issue as Europe's largest economy heads to the polls on Sunday. And the government's attitude to public spending and public debt have, of course, become key issues. Let's go now to Bloomberg Daybreak anchor Tom Mackenzie, who's gone to Berlin ahead of that vote. Tom, what's the latest where you are?
Well, Lizzy, yes, welcome from Berlin. The winds of change are here in Berlin. I mean, that is the feeling, certainly, as we lead up to these crucial votes and this crucial vote on Sunday, that there is an expectation that whoever forms the next government will have to make some adjustments in terms of the fiscal space to allow for that defence spending that you've just been talking about. Do they adjust the debt brake, and to what extent is a key question. Germany has debt to GDP of just 60%, which puts it, of course, in that enviable place where it does have the fiscal room. It just needs the political will. It also, by the way, in terms of mathematical arithmetic in the Bundestag, needs 2/3 in both houses and both chambers of the Bundestag to get through an adjustment to the debt brake. But it does seem that leading politicians, including, of course, Friedrich Merz of the CDU, who is currently polling ahead of his rivals, is open at least to some form of adjustment. Then there's the question of joint debt to fund the build-out across Europe of that defence space. That is also, we know, something that the Poles are talking about, that the French are talking about. Is it something that Germans will get on board with? Historically, of course, they've been reluctant to see, as they see it, subsidise other more profligate nations in the EU. But given the moment, given the consequential pivot point in the history of this nation and the EU, the unrailing and unravelling of the transatlantic alliance, as some have positioned it, possibly that is also something that Germany is considering. And interestingly, the Bloomberg terminal has a story today reporting, suggesting that investors are quite relaxed about the idea that Germany could borrow more to fund defence. Investors within the fixed income space would give Germany that latitude to borrow, to spend on defence. That, according to our reporting. It all comes down, of course, to what the coalition mix is going to be, if Friedrich Merz is going to be the Chancellor, of course, and if so, who he partners with. Is it the Greens, in which case they have been very supportive of more spending for Ukraine? And we heard that again from the Foreign Minister, Annalena Baerbock, who has said that she wants to see a significant package on spending. It comes down to what the coalition is. It comes down to how long it takes to put that coalition together. Will it be weeks? Will it be months? And then we will have more clarity. But the sense here in Berlin is that Germany is ready to step up, but the question is by how much?
Certainly something we're going to be keeping a very close eye on. We're about 3 or 4 days out of that crucial moment. Tom Mackenzie in Berlin, kicking off our countdown to that German election. We'll be checking back in with him over the next 2 hours of program. Let's tell you what we've got coming up on the show today. Monica Defend over at Amundi, she's the Investment Institute head there, will be joining the program. We're going to talk a little bit about the read-through from the geopolitics and, of course, the German election as well. We've got Elena Sneger, European University Institute fellow as well, and SocGen's global head of economics and cross-asset, Koku Agbo-Bloua, will be joining the program. And, of course, a special focus on the auto sector. Dirk Walschlager, Center of Automotive Research, the director there, and, of course, the former executive over IBM, joining the program. Plenty of data as well to keep on the agenda at about 1:30 p.m. UK time. U.S. housing starts are going to be very much in focus. 7 p.m. UK time. FOMC minutes. Is there any kind of wiggle room, any kind of shaking in the thinking around the tariff threat and an inflationary uptick? Certainly something you are already seeing right here in the UK. Meanwhile, the Kingdom of Saudi Arabia hosting those Ukraine talks, or at least talking about it with some of the senior officials. We should mention Vladimir Zelensky has canceled his trip to Riyadh, so we will keep a close eye on that. And then, of course, the debate between Germany's Merz and Scholz.
A busy day in terms of economics and geopolitics, but let's get you up to speed on what else you need to know this morning. The Vatican says Pope Francis is being treated for double pneumonia after scans revealed the condition in both his lungs. The 88-year-old has been in hospital in Rome since last Friday, and church officials now describe his medical situation as a complex picture. The Vatican has asked for prayers for the Roman Catholic spiritual leader, who's been head of the church since 2013. Elsewhere, Bloomberg has learned that BP is weighing a potential sale of its lubricants business. The oil majors unit, which operates under the Castrol brand, could be worth about $10 billion. A sale of the business is one of the many options BP is considering to win back investor confidence, and as activist investor Elliott Investment Management pressures the company. And Treasury Secretary Scott Bessent says US taxpayers don't need to worry about the security of their private data while Elon Musk's government efficiency team is doing its work. Bessent says Musk's department has identified about $50 billion in savings so far, and the cost-cutting effort could eventually lead to efficiencies worth several percent of GDP. So that was comments from Scott Bessent in a Fox News interview, Kriti. I mean, I'm not sure that he will have done much to assuage people's concerns about Elon Musk getting his hands on people's private data with that warning. I think when you ask for that kind of trust, it comes back to the way the likes of Elon Musk are talking when they're in front of the cameras in the Oval Office, next to their child, next to Donald Trump, kind of like a private citizen, and then, you know, working with and for the government and asking for people's trust. We are in a very, very different day and age of government in 2025.
We absolutely are. I think the numbers are here. What matters, you talked about the $50 billion there. Just to put in some context for our global audience, the tax cuts that are being expected to fund all of this, basically, or that you need the funding for, come about $5 trillion. So this is a fraction of the numbers that they're trying to get. The I believe it's 1.4 trillion is the expected tariff revenue as well. Add those together, $50 billion plus the 1.4 trillion. trillion, you get to nowhere near the $5 trillion needed over the next decade for those tax cuts. Is that something that the FOMC and, of course, economists over at the White House are thinking about? Something we're going to be talking about on the rest of the show. But coming up on the program, we're going to check on autos at the open after the news of potentially more Trump tariffs, as we were just discussing, for the entire sector. Plus, banking very much in focus as well. HSBC profits beat estimates as Europe's biggest bank restructures, incurring costs of, get this, $1.8 billion. Up next, though, we're going to go back to where we started. UK inflation rising 3% in January. We're going to dive deeper into the market impact or lack thereof. If you have any questions of your own for our guests or for us, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Monday, Germany heads to the polls following the collapse of Chancellor Scholz's coalition. With the focus on the economy, migration, and geopolitical tensions, how will the German balance of power shift? Bloomberg Television has continuing coverage leading up to the election and will bring you the results after the votes are tallied with a special post-election broadcast. Tune in Sunday, starting at 5 p.m. London time. Only on Bloomberg. Context changes everything.
Welcome back to the opening trade. We are 40 minutes away from that open in Europe. Let's talk about what happened in the States, though, yesterday. A rally in chip makers driving U.S. stocks to all-time highs, even though Donald Trump threatened further industry-wide tariffs. Let's dive into the details. Bloomberg's Valerie Teitel is all over it. Val.
All-time highs for the S&P 500. Yesterday, we breached that high seen early in January. Some of that driven by the chip makers. We had Intel jumping some 16% on speculation of a breakup. But it's interesting to know that they very much shrugged off this, again, tariff threat from Donald Trump industry-wide on pharmaceuticals, on autos, on chip makers. But I want to focus in on autos for just a moment because he did mention a number. 25% tariff on autos is what he's looking at imposing in April. And by country, Mexico is the one that is most exposed. They import the most amount of vehicles by number into the U.S. South Korea and Japan aren't farther behind. But if we break it down on a company-by-company analysis, Kriti, Germany is also a key area that has vulnerabilities here. Volkswagen, Mercedes, and BMW. As a share of total U.S. car sales, they have a very high percentage of those car sales that are imported. So very interesting to see whether we see weakness in German automakers when they open in just 30 minutes time, or would it be this shrugged off nearly completely, given that April 2nd date is still a month and a half away?
A delay that could be a positive or maybe a little bit of an overhang for those markets. We thank you so much. Let's dive into more of those details. I'm pleased to say Monica Defend, head of the Amundi Investment Institute, joins us around the table this morning. Good morning. Thank you so much for coming by. The complacency in these markets that 4 years ago would have rattled everybody around these tariff headlines, square that for us. Why are people not blinking an eye?
Well, I do believe that this love and fear framework we are enjoying as investors on the market is really linked to the fact that fundamentals still good. Look at the reporting season, plus 11%. If you look at S&P 500, reported earnings out of Max 7, plus 31%. Less than 4% in Europe. So growth is there. It is moderating, but it's still there. And all in all, the picture holds, notwithstanding all the uncertainties that we have on the geopolitical front. But investors look quite relaxed on it.
It's fascinating because you look at some of the European earnings specifically at the nexus of kind of international trade from China, from the United States as well. And so much of those earnings is one, it feels like, and correct me if I'm wrong here, the delayed impact of some of the margin and cost cutting kind of metrics that a lot of these CEOs are using. The other piece of this is front running some of that tariff impact. Is that where that market reaction is?
Yes, probably yes. Having in mind that so far nothing is really material on the tariff front. So this is what we did on our side as well in trying to pencil in the economic projection. You are making assumptions. So as long as it is still in the air, what will be eventually the final field to land, probably investors are and managers are adjusting.
I mean, how much is this about inflation? How much is inflation going to be the backstop on tariffs? Is that what's keeping investors so relaxed when it comes to the tariff threat? Because, of course, overnight we've had the 25% threat of tariffs on autos, semis and pharma. Are we going to see a big shock at the open? It doesn't look like it.
Well, inflation is on top, at the top of our wall of worries since a while. So it was the theme of our outlook as we launched at the beginning of the year. We do believe that tariffs are a lose-lose game. I mean, for the country that is imposing and for the countries that are receiving it. Roughly speaking, with a 10% on average, we do believe this could shave 0.3, 0.5 on growth and similar effect on inflation. What we've seen on the market is that break-even moved quite a bit in the short term, not as much on the long end. And this is not even penciling in what can happen in Europe when it refers to the spending on defense. Because, again, we might see even a steeper curve there, and this eventually will influence what the ECB will be doing, having in mind that the ECB probably is in a more comfortable position than the Fed.
I mean, what about the Bank of England? Because we've had this inflation data out of the UK this morning, so a beat at the headline level, a miss on services, in line on core, but all up from the month before. Does it actually change your assumptions about the BOE rate path, or do you kind of agree that the BOE is looking more at growth than inflation?
Well, they asked the GDP projection last week, so this was the news in our opinion. So definitely they will be the laggard in the past, but they will be continuing, and we didn't alter the forward guidance we had for the Bank of England.
You talked a little bit about this inflationary uptick being priced more in the front end of the curve and break-evens rather than in the long end. That dislocation that really shows up in these bond markets on both sides of the Atlantic, you can certainly see it in the UK bond market as well. Is it cushioned by extra liquidity still in the system? How are you thinking about that?
I think there are two reasons. First of all, the central banks have been doing a good job. So they are credible and they maintained the inflation expectations anchored, which is reflected in the long end of the curve. And liquidity, it is still there. Yes, definitely it is.
Well, if Jay Powell and Andrew Bailey are looking for a stamp of approval, they know to go straight to Monica.
I just also have to ask you about the German election and the markets as we go into it. How are you expecting this to pan out? I mean, there's so much riding on a coalition having the right majority to get those market-friendly reforms through. Could you see a pretty adverse reaction if you don't get that?
Honestly, I think that what is really important on that front is what will happen on the debt break. So how much they are going to relax. We do not expect any major, crack or change. It will be reformed. So it means that Germany will increase its fiscal spending, whoever will eventually get into power. And this will be pivotal at EU level. So the meeting we had early this week didn't finalize anything just because there is so much at stake. Once we get visibility on Germany, then we can decide at EU level what to do. And this will be the big news for the markets, I think.
Very quickly, in that situation, more issuance coming out, more fiscal spend from Germany. Is that a positive or a negative for yields? Very quickly.
Well, I think it is positive. We maintain this long duration on the EU side, and we do expect more steepening.
All right.
OK, Monica Tefend, head of the Amundi Investment Institute, we thank you. Great to have you around the table this morning. We're going to stay on Europe next, though. Coming up, Macron set to bring together European leaders to discuss Ukraine for a second time this week after being sidelined from talks between the US and Russia in Riyadh. We'll bring you more on what to expect next. So stay with us. This is Bloomberg. 30 minutes away from the start of the opening trade. Futures pretty flat and mixed here in Europe, bracing to think about how this tariff threat will feed in terms of semis, autos and pharma, this 25% tariff threat from Donald Trump doesn't look like there's going to be much of a reaction at the moment. Perhaps traders thinking about this more as a negotiating ploy from the White House for now. But you're seeing the CAC futures a little higher than the rest of Europe at the moment. Let's go now, though, to Germany, because despite both Brussels and Kyiv being sidelined from the Ukraine peace talks between the US and Russia, French President Emmanuel Macron is planning to hold a second meeting on European security later on today. Now, the move comes just after an earlier gathering in Paris that included the UK Prime Minister Keir Starmer, the German Chancellor Olaf Scholz, where the leaders discussed how to fund the EU's defence of Ukraine. And Tom Mackenzie is back with us now from Berlin to discuss. Tom, is Germany actually ready to spend more on defence? We were just looking at the bond story there. German 10-year bond yields higher 2 basis points at 2.51%. Yeah. Are we really going to be able to see Germany deal with this threat, this need to spend more on defence?
Well, there we go, 2.51%. I mean, that's not a painful level, is it, when you compare it to its counterparts? And that is the point when you talk to fixed income fund managers and they say they are willing to take on additional issuance from Germany. In fact, they would welcome it because of the quality of the sovereign debt of Germany. There is the space to spend here. Debt to GDP is at around 60%. Compare that to 120% for the US, over 100% for the UK. Let's not even get into Japan, 250%. So does Germany have space to spend? Yes, it does. Olaf Scholz, the current chancellor, would say he has already stepped up on that. They're now meeting that 2% of GDP target in terms of NATO spend. He spent and put in place additional $100 billion worth of funds. But will he be the chancellor after Sunday? It's looking unlikely, at least according to the polls. We will wait and see. The vote is on Sunday, and that's the key point. The coalition and who is the leader of Germany, that would be consequential. But what you're hearing, the mood music from the leaders, particularly Friedrich Merz of the CDU, who is polling ahead, that party, the CDU-CSU, polling ahead of any other major party, he is suggesting at least leaving room to be able to spend more on defence, whether that is adjusting the debt brake potentially or joint borrowing to fund additional defence spending. Friedrich Merz has not ruled those out. He wants to give him space, clearly, to enable him to have optionality if he ends up Chancellor. Then the question is, what's the coalition going to look like? What are his coalition partners going to do? Will they support that measure or hinder that measure? But the sense you get here in Berlin is that there is a willingness to spend more. What it looks like and how much that package will be is the question.
Well, Tom, we know from the regional elections that we've seen in specifically the areas of Germany, East Germany, that have more of that auto exposure, so much of the kind of ability to be a little bit more pro-Russia has started to seep into the polls. Walk us through how the defense story and that Russia angle plays into the election debate.
Yeah, that's really interesting, isn't it? The AfD, they are polling number 2, the right-wing party. Of course, some of their chapters have been described as extremist by Germany's own security forces, but they're polling at about 20%, the CDU, CSU at about 30%. AfD are second in the polls. It's very unlikely they will get into government because both the CDU and the SPD, plus the Greens and the FDP, have said they would not work with them. But the AfD are pro-Russia, essentially. They are not pro-support for Ukraine. They want to see that unwound. And there are other smaller parties as well who also lean in their direction. So if they get into Parliament, if they get into the Bundestag, they could be the spoiler. They could be a challenge to this. There is not an insignificant minority here in Germany that are backing parties that want to see far less support for Ukraine and closer ties to Russia and Moscow. So that should not be overlooked.
Tom, we've also overnight had this renewed tariff threat on autos, 25% out of the White House, maybe to be confirmed on April the 2nd. Of course, Germany will potentially be hit by that. How does it differ between the candidates in the German election, what the response would be, particularly between Olaf Scholz and Friedrich Merz?
Olaf Scholz sitting down with Bloomberg saying that ultimately they want to get a deal, of course, with the Trump administration. But they do, Europe and Germany, and he did defer to Brussels, do have tools, of course, in the toolkit in order to respond if those tariffs come through. None of the party leaders are fully committed in terms of the potential response to those tariffs because, of course, it is still hypothetical, though it does seem that the Trump administration are pretty committed to some form of tariff on Europe and pretty committed to trying to restrict the number of cars, or at least put a higher price tag and a higher tariff on the German autos shipped into their market. So is it consequential? Absolutely. The industrial base of Germany is the power behind this economy, and autos sits firmly within this. This is going to be the key priority for the next coalition, is how you deal with Trump tariffs. And that is going to be arguably the number one priority for whoever is Chancellor come Sunday.
Well, Tom, you were in Frankfurt not too long ago talking to some of the CEOs at the helm of this story, specifically when it comes to the defense story and the tariff piece. How is corporate Germany positioning for really all of these curveballs, from the politics, the defense story to the tariffs?
Well, it was very interesting, wasn't it? The ZEW survey of yesterday suggesting that investor confidence is now picking up for the first time at the highest level in about 2 years in Germany. Investors are starting here to feel a little bit more confident. What they want is political certainty. They're expecting further rate cuts from the ECB as well. That also helps. Political certainty and the expectation that you're going to get more fiscal spend and action from a government that essentially has been sidelined because of the breakdown of the coalition. And that's what I heard from the CEOs in Frankfurt. They want action. They want a cut to the regulation and the burdensome overlay of regulations here in Germany. They want actions at the Brussels level, they want action here in Berlin. They want that political certainty, and they want their political leaders to act in order to shore up this economy. And that was the clear message I got from those CEOs when I sat down with them in Frankfurt.
Yeah, that expectation of market-friendly reforms, the expectation of ECB rate cuts, pushing the ZEW confidence level the most in 2 years. Tom, thank you for that update. We'll check in again with you later in the next hour. And we're going to bring you all the news, the analysis, the market moves as we continue to build up to those German elections, including a special programme when the polls close on February the 23rd, bringing you live from Berlin. But let's also talk about the market impact, Kriti.
Yeah, absolutely. We are talking about that removal of the debt brake and what that actually looks like. Is that a positive or a negative when it comes to the yield picture? I know exactly who might have the answer. Marcus Live Executive Editor Mark Cudmore joins the program. Mark, help us work through this in this kind of concept of, okay, well, Germany may remove their debt brake. It may take them a minute to do it. We may see more issuance, but do they still get digested by this bond market, maybe the way that they have in the past?
I think it ultimately will, because I think what it does is it changes the whole growth narrative around Europe. There's a very, very kind of long established kind of idea of what Europe means, an investment idea. And this will kind of blow that up. And it's this idea that Germany is this fiscally conservative nation that's holding back spending right across the continent. Suddenly, if that debt brake is removed, you change the whole narrative and you get people excited by the European story again. You get flows into euro, you get flows into European equities. And I think that ultimately the bond market will cope okay. This does not mean that we don't get more scares like we've had in France and Italy over the recent years, and they will come up again. I'm just saying that I don't think it'll be traded as a major kind of negative for the bond market. What's interesting is, as we go into this election, investors are determined for that euro dollar should fall again. We came into this year with the market very bearish euro dollar. That was a completely consensus trade. Sorry, bearish euro dollar. So they're bearish euro and bullish the dollar. And suddenly they're kind of being very disappointed in that trade. It's not working very well. It's going against them. And so many are kind of touting this idea that after the German election this weekend, we'll see a resumption of the euro dollar bear trend. I am worried that in fact the asymmetric skew might in fact be the other direction.
OK, so we wait for the results of those polls. Meanwhile, Mark, the question of the day on the MLive blog is, how long will TINA, the there is no alternative narrative, endure for US stocks? You say the narrative's already changed on US exceptionalism. So what's the alternative?
Absolutely, Lizzie. I'm glad you asked me this, because I got annoyed with my own team today for asking this question. I think TINA has been fatally wounded already. I think that the fact is that the Trump is changing the whole narrative around US markets exceptionalism. Far from paying a premium to be involved in a US supply chain, you'll now pay a premium to have business that is outside the US supply chain. And that is a very, very important and subtle shift. Also, I think the fact is that US companies being so expensive, part of that premium was that they were going to be the sole beneficiaries of the AI productivity boom. And I think that that is very much being challenged. People are realizing that the beneficiaries that will be many different companies around the world. And therefore, the productivity boom is global. And therefore, why not go for stock markets that are cheap and discounted because they're perceived to be missing out in that? So I think both tariffs and the changing narrative around AI means that US exceptionalism is over. There is definitely an alternative.
Very quickly, Mark, how does that show up in the FX space? If we're talking about this dollar exceptionalism going away, but Europe also weakening, what happens to euro dollar?
I think dollar weakens in 2025. It'll be a volatile path, but I absolutely think that Donald Trump flagged the green light to start the dollar bearish trade last week when he undermined the Fed right before a hot CPI. It is a dollar bearish year.
We'll certainly see if that comes to fruition. Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. You get more up-to-date analysis from him and the team. MLIV Go is the function on your Bloomberg terminal. Coming up on the program, HSBC profits beating estimates as Europe's biggest bank restructures. Incurring costs of, get this, $1.8 billion is one of today's stocks to watch. We're going to dive into the details next. This is Bloomberg.
Well, we are heading towards the opening trade, just under 15 minutes to go. And as we look at the futures picture, pretty flat to the downside for Euro Stoxx 50 futures by 1/10%. Flat on the FTSE 100 futures, though. And we have had earnings out of some key names in London, the likes of BAE Systems, a beat on estimates there, strong demand for weapons, a beat on pre-tax profit for HSBC as well. So those should factor in, but pretty flat across the board, Kriti, as we head towards today's session.
Yeah, absolutely. And this is all going to be coming in tandem with the fact that we have seen Europe have this moment in the sun, specifically over in Germany, which is interesting. We're in the countdown to that German election, and yet the DAX has outperformed in a really big way. Now, some of that is simply going to be the bit of the peace dividend. Some of that is going to be reversing some of the maybe tariff bits that is already priced, very much priced in. But then you are also looking at the outperformance, not just of the Stoxx 600, but of the S&P 500 as well. The defense stocks story really catching everyone's eye. But I mean, the outperformance is crucial. The question is, how sustainable is it, especially as we get perhaps a little bit more policy direction come Monday morning?
Yeah, and we can also see this chart on TINA faltering. This is exactly what Mark Cudmore was talking about. The debate, it seems to be on the MLive team, whether there is an alternative to US exceptionalism. Mark seems to think so, evidently. But it comes back to our conversation with Monica Defend, right? When is that seeming complacency among investors about the tariff threat, about the geopolitics, actually going to show some cracks when it comes to US equities?
Yeah, absolutely. And this doesn't even factor into some of the other pieces as well. If we're talking about energy increases or commodity increases, that's going to show up in those margin pressures. We're talking about European parity, euro dollar, for example, heading or was barreling down to that parity level. Does that affect the bid into European stocks? It's fascinating to see euro higher and stocks higher at the same time. A little bit perhaps of love coming from the domestic audience rather than the international one.
Yeah, well, let's dive into some of the individual stock names that we're watching as we head towards the open. Joe Easton from our equities team is on standby. Joe, what are you watching?
Morning, Lizzy. So HSBC numbers looking pretty strong in terms of their net interest income, and they are continuing to cut costs, including that massive restructuring that we've recently seen. The shares did rise in Asia, but have actually trimmed a lot of the gain in latest trading, only up 0.3%. Now, potentially, that's due to the big rise we've already seen in this stock over the past year. We can see it there, up around 60%. It's had a decent run over the past few weeks as well. Then in terms of defence, as you were discussing there, we've got numbers from BAE Systems. Unsurprisingly, a massive step up in orders once again for the UK company. However, it has, of course, been part of this big rise that we've seen in defence stocks over the past week. We can see it up 11% almost on a 5-day basis. And if we look back to before the conflict broke out in Eastern Europe, that stock has more than doubled, to potentially a lot of those stronger orders priced into this one, but we might see it a little bit higher later. Then in health techs, Health technology, this one is looking a little bit weak for Philips. Now, the company has missed on some of the low end of its guidance, according to analysts, in terms of some of its sales. It has been a volatile one, given that continued issue around the sleep apnea recall device. That does seem to be clearing at the moment. But analysts not really yet willing to pile into the buy rating. We've got 14 sitting on the sidelines waiting for the outlook to clear on that one. Keep an eye on that one. Might be lower in Amsterdam. Then on analyst ratings, a few decent ones today. ST Micro and Chips could get a boost as Jefferies recommends buying. Anto in the miners overweight at JPM, and Deliveroo set to be lower as Citigroup recommends selling that one on the German exchange today.
Certainly something we're going to be keeping a very, very close eye on. Fascinating to get some of these earnings stories and the reason that these analysts are changing. Joe Easton, our equities reporter, walking us through that story. I want to go back to the markets here because we are in the countdown, of course, to that German election. We are getting those tariff threats as well from over the states, not to mention the geopolitics. I want to bring in Valerie Teitel for a little bit more analysis here. Val, we've been focusing so much on the equity markets, this defense outperformance. Talk to me about the currency picture, because I feel like 2 weeks ago we had these massive volatility in the peso and the Canadian dollar. What happened? Where's that panic in the euro?
Well, it turned out that these tariff threats are just leading to negotiation instead of actual implementation. So if you take that off the board, volatility across FX has really paired a lot of its recent heightening that it did have around the election and then around these the tariff threats. But frankly, we can go back to talking about this TINA narrative coming apart, because that is a big dollar negative. You have to think about if there's an end to the Ukraine war, if somehow Russia is brought back into the Western world, and this whole idea of this multipolar world really comes to bed. That opens up a lot more international assets for investors to be looking at. You can think about Chinese assets, for example. A lot of investors really shunned moving into China because of the political tensions between the U.S. And President Xi Jinping in Asia. If that's also put to bed, that just opens up another sector, another era where U.S. investors can invest in outside of U.S. assets. And that is a big, big dollar negative story, and one that we should be following. This idea that this multipolar world, one that we've really talked about, the East versus the West, China and Russia versus the U.S., if that's really put to bed, big dollar negative ahead.
Yeah, I mean, what does it mean for oil? Because, if you have Russia suddenly able to get a Ukraine peace in its own, the kind of peace that Russia wants, how beneficial is that then for Russian flows?
Yeah, for two sides of the coin, right? You have Trump pushing more production of U.S. oil, and then you bring back, one of the major oil generators in the world, Russia, back into the globe. Big negative for oil, and could perhaps boost a lot of global growth, not just in the U.S., but in Europe, who has also been suffering from high energy prices.
All right, Bloomberg's Valerie Teitel walking us through some of that. It's really fascinating. Of course, we are getting a little bit of market reaction. We'll see if that shows up. But all of this, of course, overshadowed by the geopolitics. President Trump, of course, saying he will, quote, probably meet with Russia's Vladimir Putin by the end of the month. That comes after the top U.S. and Russian diplomats raised the possibility of broader cooperation. Joining us now is Alina Snegier, European University Institute Fellow. She does join us on the phone. Alina, a pleasure to have you on the program. We look forward to your analysis. This is important as we talk simply about whether or not this rehabilitation of Russia or these early signs of it are a good thing for Europe. Your thoughts?
Yeah, hi. Thank you for having me, and it's my pleasure. To my mind, it's obviously a dangerous thing for Europe because Russia has actually all that it wanted and still wants. It has the war because Russia is intended to continue the war because Russian economy is completely reassembled reconstructed as a war economy now. And so Russia will continue the war because it also legitimizes the Russian leadership before Russian society. So it's a very strong consolidating factor. The other thing that Russia also is very keen and successful in negotiations, in useless and fruitless negotiations, like negotiations just for negotiations. And meantime, Russia continues the war and continues its aggressive and assertive foreign policy. And Russia wanted from the very beginning. Russia demanded that it's not about Ukraine, it's about the European security order and Russian influence in Europe. And now Russia has it on the table. Like Russia demanded that these negotiations are not with Ukraine, must not be with Ukraine, but with the United States. And Russia has it on the table already. So, and Europe is now at the place, some kind of the place of Ukraine when Russia says that Europe decides nothing, that Europe is not, doesn't have an agency, but there are two, actually three maybe, but right now two global actors who will decide the fate of Europe. So for Europe, there are no good news, unfortunately.
Yeah. I mean, Alina, I'm really wondering whether Europe is understanding Russia at this point. The whole idea of peacekeeping troops in Ukraine seems anathema to Vladimir Putin. The idea that you'd have NATO troops on the ground, as Starmer is suggesting, surely that is never going to fly with Vladimir Putin.
Yeah, of course. So about understand if Europe understands. I think right now they're a kind of awakening. So they are frightened. They probably do not understand it yet, or it's very hard indeed to accept this reality, even if you understand it. It's very hard to accept that your life is changing in a bad way, and you still hope that this normality would continue, but it wouldn't. So for Europe, it's indeed very the last wake-up call. I mean, because it's not just about Russia, it's about the closest ally, which is not probably an ally anymore. We don't know yet the future actions of the real actions of Trump administrations, what they would do. Right now, they're just saying something, but the actions. So for Europe, it's indeed, and the salvation for Europe.
Alina. Sorry. Yeah, Alina Snigia, European University Institute Fellow. I'm sorry, we'll have to leave it there, but really great to get your analysis. We're heading towards the opening trade. That's next. This is Bloomberg.
A few minutes ago until the opening trade, a little bit of an interesting session over in the U.S. because you did see a little bit of a rally. Perhaps this is where you are seeing the stage set for today's trading day. Let me walk you through it. This white line, of course, is the European session. Seeing some positivity. A lot of that was driven over in the DAX. A lot of that was driven, by the way, by that German defense sector. The peace dividend very much showing up right here and continuing over into the U.S. session, pairing some of those gains only for the chip sector to stage a final comeback. And that's what closed the states into the green in those final minutes. Now, this is crucial because how much of this is really a reflection of the geopolitics? How much of this ultimately is a earnings story on that side of the Atlantic? Let's take a quick look at the futures picture, because when I say cautious, I mean cautious. Underperformance in Eurostoxx 50, perhaps paring back some of the gains we've seen. But if there is one place, I'm going to call it marginal moves to keep an eye on, it's the CAC, and of course one hand on the DAX as well, Lizzy.
Yeah, looking at some of the individual stocks that we're watching as we head towards the open, Kriti, we have had various bits of earnings this morning. HSBC reporting a profit beat, a $2 billion share buyback. BAE Systems beating estimates, strong demand for weapons as we've been discussing. Philips turning back to growth for the first time in 3 years because they've resolved mostly their issues on the sleep apnea devices. But then, of course, we factor in the tariff story, semis, autos and pharma in focus, and defence stocks again as the Ukraine talks keep going.
Certainly something we're going to be keeping a very, very close eye on. When you look at the futures picture, already you are seeing a little bit of caution. This is important simply because we know that the outperformance of the DAX has been driving the rally specifically in Europe. It's been a defense story. Some of it has also been a little bit of an earnings story. Lizzy, you pointed to that. That rotation is going to be crucial. The earnings picture is happening at the same time when we're seeing that moment in the sun show up in the currencies picture. It is, of course, the opening trade right here in Europe. It might take a little bit to get some of these pricing here, but right off the bat, slightly negative sentiment coming point from the FTSE 100. Underperformance over in Spain as well. The IBEX there down about 0.2%. Remember, if we're talking about autos, pharma, semiconductors, remember what the second biggest manufacturing hub in Europe is. It's Germany and then it's Spain. So really perhaps reflected in the sentiment over in the Spanish index. Getting opening prices on the stock 600 as well. Flat at the moment. Of course, we're going to wait for a few minutes for some of that pricing to go through the French and the German indexes. But for now, sentiment already kind of flat, kind of cautious, not seeing the exuberance, Lizzy, that we've seen in the last couple of weeks or days.
Yes, indeed. We wait again for the DAX to open. But as we look at the sectoral picture, for now, we have about half of sectors in positive territory. Energy leading the gains this morning, higher 0.5%. Bottom of the basket is travel and leisure. Those shares down 0.5% as a sector this morning. We've been talking about the defence names, Kriti. Rheinmetall eking out gains again, Leonardo too. But the likes of Thales actually in the red. So it's a mixed picture today when it comes to defence. That narrative a bit more mixed today, but we have had results, as I say, from HSBC. Those shares up 0.2% following what we saw over in Hong Kong, and we also have BAE Systems higher 0.3% off the back of their earnings. Glencore down 3.75%. Interesting that Glencore is actually looking at moving its primary listing over to London, and that would really be a blow, of course, wouldn't it, to the government, with Glencore having been on the London Stock Exchange since 2011. So another stock looking to move its listing out of London.
Absolutely. Those shares down about 4% as we speak. Right off the bat, we are seeing a reflection show up in some of those autos stocks as well. So that's where my focus is. Energy seems to be the outperformer. BP, Total, Shell, of course, taking the cake there, as you mentioned. Glencore on the backseat. Take a look at the movers, though, for the downside. Novo Nordisk and Mercedes-Benz. There's your tariff story. There's your tariff threat. Specifically, as we talk about the countdown to the German election, Novo Nordisk down about 1.4% there. Mercedes-Benz down about 0.9%. I'm also trying to get a clearer price on HSBC here, because we do know they're talking about a restructuring. We're talking about those cost cuts, those earnings coming out earlier as well, higher by about 0.1%.
Yeah, I just want to check in on the bond picture as well, because, of course, we did have that UK CPI number at 7 a.m. London time, and we actually have on the 10-year yield up a basis point at 4.57%, so barely any movement there. Up a basis point on the 2-year yield as well at 4.2%. So really not a lot to write home about, as I say, because the Bank of England perhaps more focused at this point on the growth story than the inflation story, even if you have seen increases at the headline core and services levels when it comes to UK inflation. Well, we can discuss more now with Koku Agbo-Bloua, who is Global Head of Economics and Cross-Asset and Quant Research over at SocGen Corporate and Investment Banking. Really good to have you with us. Let's just start, though, with that inflation story here in the UK, then. Do you agree that actually the focus has turned to growth from inflation? That seemed to be what analysts are saying off the back of that BOE meeting recently, cutting despite upping the inflation forecast.
Yeah, absolutely. I think it is quite a conundrum, because you need to solve these sort of inflation virus that really started with COVID. And this is sort of the original sin, so to speak, because government spent a huge amount of money to save human lives. And ultimately, we're paying the price of too much government debt, etc. But the whole point of raising interest rate is to slow down growth and slow down consumption, so that inflation in turn can come back down. But then we have this dilemma of, if you have not enough growth, then tax receipts fall and debt and deficit increases. So I think it's clearly a focus on trying to move out of too much debt through growth, as opposed to having to raise taxes and cut spending. So it's clearly a balancing act, both from government and central bank, to make sure inflation goes back to target, and that we can lower interest rate over time, so that it doesn't sort of forces us into another stagflationary environment.
Yeah, I mean, our reporters have been talking about the Treasury asking non-protected government departments to cut, in real terms, budgets by 11%, maybe to fund that defence spending. When you hear about that, which some would call austerity, how does that make you feel about investing in the UK?
Well, it definitely increases uncertainty. I think the UK has, I mean, since Brexit, sort of a sticky labour market, because we have less migrant workers. And I think ultimately what matters is trying to increase productivity gains to make sure that we are able to offset this upward pressure we have on from the labour market side and sticky wages into a more sustainable inflation going forward. But listen, I think at the end of the day, there are a lot of issues that the government will have to deal with: aging population, climate change, and financing the energy transition, and as you mentioned, defense. And this is at a time where debt to GDP have increased quite meaningfully across Europe. And this is where we'll have to find ways of perhaps changing the goalposts in the medium to long term.
Yeah, I mean, I've seen the only place that borrows at rates like the Bank of England's with this sort of growth is Italy. Really concerning that you underscore that.
Yeah, it's fascinating because at the same time we're talking about offsetting some of the public deficits with, on the one hand, more spending in Europe or perhaps spending cuts in the United States. That's what we're hearing, at least some of that offset by the likes of tariffs, for example. At least that's what's being floated by the American administration. Let's talk about that tariff story. Of course, Donald Trump overnight talking about tariffs in Europe, in autos, pharma, semiconductors. You're seeing a little bit show up of that in the likes of Mercedes-Benz and Novo Nordisk. Is that something the market should be more actively pricing? I'm just comparing this to the last time, the last administration. There was way more panic, and now there seems to be less so. How do you square that?
Well, that's a perfect point, because at the beginning of the year, even end of last year, you saw 10-year bond yield in the US rising on the fear that we will have a widespread tariff across the board, and that would potentially trigger another inflation outbreak. And yet, if you look at the price action, bond yields, after rising roughly 50 basis points, have come down 40 to 60 basis points, simply because tariffs are not set in a permanent manner. So we saw that with Canada and Mexico. So the market is seeing tariff more as a negotiation tactic than it is a disruptive sort of measure for global trade. That being said, there's definitely a scenario where we could see, President Trump could definitely change his mind, but the market is less concerned on tariff today than it was at the beginning of the year. I think what matters more is how you reduce deficits, and I think the government Trump plan and Scott Bessent mentioning the 3-3-3, so 3% deficit, 3% growth, and 3 million barrels of oil equivalent, is an interesting focus, because if you're able to bring down deficit, maybe tariff may not be needed as much as it is today, given the magnitude of the deficit.
Yeah, absolutely. I mean, I think speaking of the tariff, the numbers coming out of Mario Draghi's kind of FT column over the weekend has got everyone scratching their head more so than usual. I want to come back to that kind of tariff and inflationary piece as well, because they're interrelated. I love that your title is Global Head of Economics and Cross Asset, because again, I'm going back by the Trump playbook from his first administration, where higher bond prices equaled sell-off in equities, higher dollar equaled sell-off in equities. What is the cross-asset correlation that moves the equity market?
Well, this is an important question, because when you look at multi-asset portfolio construction, the Achilles heel of every multi-asset portfolio is the equity bond correlation. And this is how the whole industry was able to thrive, because when bonds go up, equities go down, or vice versa. So bonds are supposedly the safe haven. And what we saw in 2022, 2023 is the lack of diversification, because equity and bonds fell at the same time.
Yeah.
And today, with central banks starting to cut interest rates, so we had 100 basis point cuts by the Fed and the ECB last year, we're starting to see equity bond, the normal nature of equity bond correlation reasserting itself. So in general, when we have sell-off, after the DeepSeek event, for example, you saw the bond market rising and offsetting some of that, the losses from your equity portfolio. So we think that going forward, this will reassert itself because we're no longer fighting inflation as much as before, hence the previous question that we focused on. Because central banks have moved away from aggressively fighting inflation to preserving growth as much as possible.
So this moment in the sun that Europe is having right now, you're seeing it in the currency market, you're seeing it in the equity market. Everyone's like, oh, Europe is performing. The fundamentals are looking strong.
Yeah.
Apparently that dynamic has completely changed in the last 5 weeks or so. How sustainable is that? Is this just a temporary rotation? How are you thinking about it?
Well, this is where I think we should quote the great philosopher Mike Tyson, who once said, everyone has a plan until they get punched in the face.
Yeah.
I think clearly the valuation gap between US and Europe has been at extremes. And what you're seeing now is a sort of normalization of some of that dispersion. But we think it has legs. So we sort of see roughly 10-15% upside because the valuation in Europe and also the positioning has been so low. So European banks are obviously outperforming. But I also want to mention one interesting phenomenon is China. So the Chinese shares are the best performing globally, up roughly 15%, a bit more than Europe. And this is since DeepSeek. So maybe we may have the Chinese Magnificent Seven driving the Asian shares after having underperformed significantly over the past few years. So that's something to monitor. But for now, we see the valuation gap closing by roughly 20-30%. But we don't think it changes the fundamental issues of Europe in terms of profitability, productivity, etc.
That was a lot of grown-up fancy talk for saying European equities are about to get punched in the face, is what that sounds like.
Yeah, I mean, Markets Live have been talking about how defence stocks in particularly are having their moment in the sun, as you say, Kriti, but they're more overbought now than US tech in the AI and .com bubbles. You're kind of saying that, especially including for defence, traders just got to chill out a bit.
Well, I mean, if you look at investing, there are different dimensions to markets. So you can trade equity bond, you can trade style, etc. And thematic basket adds more diversification. So let's say new dimension to the way you can invest. So thematic basket around rebuild Ukraine or defense clearly have done very well. But I think it has a lot more leg because, you know, Europe needs to spend between 2 to 3% potentially of GDP for defense, according to NATO guidance or rules. We're talking hundreds of billions of dollars. So these are, in our calculation, roughly 10 to 15% revenue growth for the sector going forward. But I do agree that when you have themes like that, they can get overbought very quickly. But I think it is only the beginning, and we don't see this to be in overpriced territory just yet.
Okay.
One way to trade this, however, is not just simply buy the defense stocks, is to buy the whole supply chains. Because it will be the manufacturer, but also the parts and equipment that will benefit.
You said the entire supply chain. That brings into focus the commodity sector. We're talking, and I'm having a little bit of AI deja vu here, in that you invest in the AI players, but you don't invest, and then you go on to invest in the grids, the chip makers, etc. Who is that second level or that second tier in the defense space? Because to me, it immediately sounds like ammunition factories, aluminum makers, steel makers. Is that the way to think about it?
Yeah, I think it's also probably in terms of logistics and sort of all the advisory, IT equipment, etc. That's how we design our baskets. But I think the commodity picture in of itself is going to be more relevant to the energy transition and climate change fight than the defense aspect of things in terms of usage and metal intensity, for example.
All right, fascinating conversation. Agbo-Bloua, Global Head of Economics, Cross-Asset and Quant Research over at SocGen Corporate and Investment Banking. Fascinating. Maybe we might just get a punch in the face to European stocks. We may also get a continued moment of sun. Fascinating to have that conversation. Just a quick check on how German markets are doing. Tom Mackenzie is in Berlin. He's at the epicenter of where all of that price action may actually show up. Tom.
Yeah, and still in the sun, literally, with the sun out here in Berlin, but also on German stocks as well, because the DAX is up, despite the tariff threats. The DAX is up about 0.2%. And let's remind ourselves that the German index is up about 15% year-to-date, outperforming substantially the S&P, of course, which has put in gains of a little over 4%. So the gains continue, despite the tariff threat. Yes, autos are under pressure. We'll break it down in a second. But there's the top-line read on the German market today, up 0.2%. We'll see how that evolves through the session. Let's flip the board and have a look at the auto sector then, because, of course, the majority of cars produced here in Germany are shipped overseas. It's a sector that accounts for about 780,000 jobs, about 5% of GDP. So when you're talking about tariffs of 25%, that is consequential, of course, for the German auto market. So you look at BMW right now, down 0.7%. Mercedes also under pressure. This is the pain trade when it comes to the tariff risk from Trump, potentially April the 2nd. Modest downside coming through, not a massive sell-off, but the pressure is there. VW also down by about 0.5%. Let's have a look as well at the industrials. And within the mix, of course, the defence sector that you've just been talking about, the gains that have come through there. I see that Rheinmetall is one of the best performing stocks again in the session today across the European space. And you're seeing those gains again, 2.8% on the upside for Rheinmetall. Infineon, this is the chip space, of course, currently gaining 0.9%. There's been an upgrade for ST Micro, so there may be a read across there. ThyssenKrupp down 0.3, and Siemens currently flat. The industrial space, with the defence sector basket in there, how much more upside? Goldman Sachs telling us yesterday that they think there is, Sharon Bell, there is further upside to those defence names. On the yield story, and you were just talking to your guest about the interaction between yields and equities, let's check in then on the benchmark 10-year, with yields up again today in the session by about 2 basis points on the German Bund, the 10-year. Here's the background as well. Yields are up just 15 basis points year to date. So yes, they have sold off, but not to the extent that would cause panic. You would have thought 251 or thereabouts on the 10-year. There you go, 251 on the 10-year. Again, 15 basis point move higher year to date on those yields. 200 basis points different versus the benchmark 10-year in the US. And that's where you're thinking if you're looking at additional issuance for Germany. 251, that's a move across the yields. A little bit more selling in the session today, but not a massive pain trade in the bond markets. Kriti.
We'll see if that pain trade shows up on Monday. Tom Mackenzie joining us out of Berlin to walk us through how some of the German indexes are performing. With plenty of other earnings stories to digest to, let's get a quick check on some of the other individual stocks in focus. Joe Easton has that for us. Joe.
So we have got a big drop for Philips today in Amsterdam. Now the company guiding for some of their sales towards the low end of a previous range that the company had given. Now bear in mind it has been hit a lot over the past couple of years by that recall on that sleep device, but that stock getting one of those Mike Tyson right hands this morning. I had to throw that one in there, and it is falling on that guidance. It is the worst performer across the Stocks Europe 600 index this morning for Philips. Then in looking at the defence stocks, we did have BAE out with those strong sales numbers, but that does a lot look like it's priced in potentially given the rally that we've seen over the past year for that one. MTU Aeros, meanwhile, over in Germany, looking a little bit soft on some of their margin lines. That's more exposed to the commercial airlines, but also a big defence business as well. And as Tom was mentioning, Rheinmetall extending that rally that we've seen over the past week. We have got an increased price target from Kepler Cheuvreux following the Munich Security Conference that they say will continue to boost spending for Rheinmetall. Then in terms of the banking stocks, HSBC looking a little bit lacklustre on that one today. The net interest income did look strong, but the stock pretty much gave up all of the gains that we saw in Asia trading over the past couple of hours, and it has risen by around 50% over the past year for that one. So potentially, even though they're doing a lot of that cost cutting at the bank, it's not really feeding through into the market at the moment. Then we got Glencore potentially going to break a few of our hearts here in London. Don't go, Glencore, we want you to stay. It is down 3% though. The company flagging that they are potentially looking at shifting their listing, but mainly the reason the stock is down is because the copper outlook looks a little bit weak from the company this morning in terms of the exposure mainly to China for that company. Then in terms of a couple more that were slipping lower, we did have a downgrade in the Nordics, this one for Swedbank over at Bank of America going underperform, saying it has the worst net interest income outlook across the Nordic banking space. They're recommending selling that one, and it's falling over in Stockholm. And finally, ST Micro, Tom did touch in on that one as well. That stock really jumping up almost 7% now. That's as Jefferies upgrades to buy. Now, bear in mind, this is partly due to the Apple iPhone exposure. Apple have got a big event later today, potentially going to announce a cheaper version of the iPhone. I could do one of those, I think. But the ST Micro stock rallying 7% over in Italy as Jefferies upgrades that one to buy this morning.
All right, a lot happening under the hood of that flat Stock 600 this morning. Joe Easton from our equities team, we thank you for walking us through it. But coming up, we're going to dive even more deeply into HSBC and those results that have come out this morning. Shares, as Joe says, down despite the cost-cutting plans and the buyback announcement. So we'll break down those results from Europe's largest bank next. This is Bloomberg. 22 minutes into the cash trade here in Europe, and we are looking at HSBC shares down more than 1% after their earnings. They actually reported fourth quarter pre-tax profit of $2.3 billion, beating estimates, and a buyback. So what's going on? Let's speak to Bloomberg Intelligence's senior banks analyst, Tomáš Nerzel. Tomáš, what's going on here? Why aren't traders liking what they see when it comes to HSBC?
It's not about any bad news, or maybe it is more about lack of news. If you look at the HSBC share price rally since August last year, it's more than 30%. So market was expecting what the bank delivered today in terms of ROTE expectations. I think there's a better outlook for NII this year, which is positive, I think. But, you know, because of this rally, market expected this. Most of the good news were already priced in the stock. So there's not about bad news. It's about maybe disappointment about the cost-saving program they delivered.
Talk us through then the buyback story, because I think it's fascinating. When you see cost savings like that, it's either loved by the market or hated by the market in terms of the direction it's going in. Buybacks are not being well received. That's usually a positive catalyst.
Yeah, well, look at HSBC. With today's announcement of 2 billion, they will deliver 11 billion for 2024. So it's a massive buybacks, and with the ROTE and a very strong CET1, they're gonna keep possibly buying back more shares in 2025. So the story is not changed. 2 billion, 3 billion, well, the market was expecting this level. So as well, there's no negative surprise. It was sort of expected by the market. So 2 billion was the lower mark, and they delivered on this one.
Buy the rumor, sell the news, perhaps. Tamaj Netzel joining us from Bloomberg Intelligence on the nitty-gritty of HSBC shares. Those are down about 1.4%. Not the only one. In good company, Glencore shares also slumping. The company posting a slide in their full-year profit. It's the world's biggest commodity trader, saying that the optimal location from its primary listing, quote, remains under study, feeling a little bit of speculation about what would be the most high-profile exit from the UK exchange to date. Keir Starmer's worst nightmare, I imagine. Let's bring in Mark Burton, who leads Bloomberg's metals and mining coverage. All right, walk us through this. There's so much news flow around Glencore right now. What is top of mind for you?
Well, I think the debate around whether it should remain in London is obviously key. It would be more bad news for the London market. It hasn't been too specific about what would kind of drive a move to another exchange, but if you look at some of its kind of its core businesses, and you look at what some of its kind of competitors have been doing, you can kind of imagine why a shift might be under consideration. Glencore obviously has a massive coal business, and when it acquired a majority share of its rival Teck's coal business, it was originally planning to spin that out and list it in New York, where the kind of investor mood towards coal miners has kind of brightened since Trump's success in the elections. The coal market generally has been under a lot of pressure because prices have fallen, but that I think is one kind of possibility that a move to New York might look appealing. BHP obviously was kind of pressured into or encouraged into a move over to Sydney. Rio similarly has kind of faced pressure to do the same. Yeah. So there's a kind of a broader debate about whether there's just an irresolvable valuation gap in the London market relative to peer exchanges.
But of course, we've seen other miners reporting. BHP profits also slumping on the China weakness yesterday. Is this kind of much of what we're seeing among the miners, what we've seen from Glencore today?
Yeah, I think BHP's results told you everything you need to know about the weakening kind of iron ore outlook specifically. Glencore, by comparison, is kind of very light in iron ore, but all of its other key commodities, there's been a lot going on there, not all of it positive. The drop in coal prices is one drag. Cobalt, previously a major boon for Glencore as formerly the world's top supplier. Yeah. Cobalt prices have absolutely collapsed, and that's a major drag as well. A few other bits and pieces not performing too well either. All
right, Mark Burton, who leads our Bloomberg metals and mining coverage, we thank you. As we look at Glencore shares down 4.3% off the back of that potential look to move elsewhere for its London listing. But coming up on the programme, Trump says he's preparing to impose tariffs of 25% on car imports. We'll discuss next. This is Bloomberg.
This is the opening trader at 30 minutes into today's session, seeing a little bit of caution, but again, outperformance in the DAX. And this is a consistent theme, of course, in the run-up to the German election. May see a little bit more fiscal spend there, may see a little bit more emphasis on the defense space. The rest of these markets certainly falling short of that outperformance. Or green on the screen you're seeing in Germany. The FTSE 100, for example, down about 0.2%. That spread widening between the DAX and the UK. Let's continue that conversation about Germany, because investor confidence in Germany's economy has improved significantly. The ZEW Institute's index of expectations rising to 26 in February. And get this, just 10.3 in January. Let's figure out what's going on with those numbers. Let's bring in Bloomberg's Tom Mackenzie, of course, on location in Berlin, alongside our European correspondent, Oliver Crook, also joining us in Berlin. Tom, let's start there. Let's complete 180 in turnaround. Has optimism taken over Germany?
Well, I wouldn't go that far. I mean, it's a beautiful day here in Kriti. Certainly, the sun is shining, and the investor community is feeling a little bit more upbeat. What they are craving here is political certainty and political action. They need to see a government in place. They want to see a coalition being put to place in a rapid succession, a number of days, number of weeks, arguably, and then they want to see a government that can actually push through policy and act on policy pledges already made. They want action and they want political stability. They also expect, of course, rate cuts are going to continue from the ECB, so that is a factor as well. But the backdrop, Kriti, is that we've had 2 straight years of stagnation here in this German economy. And of course, for 2025, the expectation is if you're going to get any growth at all, it's going to be lackluster, possibly at 0.3%. Who better to get the analysis on this, and bringing in Oliver Crook, our German correspondent, of course, who's been keeping the finger firmly on the pulse of the German economy, the sentiment here as well. What do you read into this, Ollie? How significant is this? We're starting to see a little bit of a turnaround in investor sentiment, but broad-based, this is a challenged economy.
Yeah, I mean, I think it'd be difficult to have a more negative view of basically what the sort of German political establishment has been able to deliver over the last sort of year and a half. So sort of anything that can bring any kind of clarity, particularly if it's a CDU, sort of more business-friendly led government, that is going to boost up expectations a little bit. But if you really look at all the other economic surveys, forget ZEW yesterday, you look at, for example, the auto industry, everything is still rock bottom and it is still going down. We're still not even at the bottom, I think, of the job cutting cycle within the auto industry. That is coming, continuously, tens of thousands of jobs being cut. And we have, earnings coming out this week. We have Mercedes tomorrow. What is that outlook worth when you have Donald Trump talking about potential 25% tariffs? It's basically worthless, right? And you sort of think about the sort of complexity of the auto industry for the German car makers. Yes, a lot of their cars go over to the United States, but a lot of the SUVs, for example, just for Mercedes-Benz that are built in the United States, those are sold over here in Germany. So this throws up a huge amount of complexity for all of these car companies trying to grapple with, the sort of, obviously, the electrification transition, but then again, with the tariffs. Again, if you get any sort of trade action against Germany this year, I think it almost guarantees you a third year of contraction. That hasn't happened since 89.
And you talk about the complexity, because BMW, I believe it's right in saying that they have their biggest manufacturing plant globally is in the US, right? So if you get the reciprocal tariffs from the EU, that's the complexity for those German automakers. What are the leading candidates saying that they will do to support the auto industry that's facing a multitude of challenges?
Listen, at the end of the day, I think that, and this is something that when you talk to a lot of these sort of commentators on Germany, is that no one is really coming forward with a plan that is radical enough that sort of meets the moment for what is going on in the German economy, right? There's a question of the debt brake. I think this is a fundamental question. We start to hear every now and then from Friedrich Merz saying that, oh, maybe we'll take a look at the debt brake. There needs to be something done decisively here. I mean, I was speaking to Adam Posen yesterday about this, that basically these are the things that fundamentally need to change, that and joint debt at the European level. There is an opportunity for Friedrich Merz coming in as Chancellor of Germany, coming in with a fresh mandate to really fill the leadership vacuum that has existed at the European level, particularly if the Germans are willing to bring that ship of joint debt to the negotiating table in Brussels. It will give him an immense amount of power in terms of shaping what the future of Europe looks like if he's willing to do that. By the way, earlier in the week, we still got the alarm bells ringing from Mario Draghi saying that basically, guys, this has only become more pressing. When I wrote this report, China was a big threat. Right now, it's the United States. It's time to get our act together.
Yeah, and the irony, of course, that it could be the Trump administration that forces that more radical approach that you say many are calling for here in Germany. Kriti, Lizzy.
Yeah, Tom, I'm seeing Rheinmetall shares up over 1% today. They've just in the past hour had German military, they've won a German military contract worth up to 260 million euros. So if we can pivot from autos to defence, I wonder, I know you've been on the ground for about a day, Tom, are you hearing more excitement when it comes to industrial policy from the candidates in terms of defence as much as on autos?
Well, it ties back to what Ollie was saying, which is the crucial question is whether or not the debt brake will be reformed so that it can allow that additional spend. And as we've been hearing, Annalena Baerbock, of course, the Foreign Secretary here in Germany, has suggested that there is a big package of spending coming through. Of course, Merz, who is the leading candidate, the CDU, has suggested he's open to additional spending. Ollie, you've been thinking about this as well in terms of what the ability is. Chancellor Scholz let's not forget, has pushed through $100 billion euros of additional spending. That's come through. Germany is now meeting that 2% target for NATO. Of course, the expectation, the Bloomberg analysis is you need to be plus, or the NATO analysis is you need to be a plus 3% to get to NATO where it needs to be. Is Germany ready to spend?
I mean, they're beginning to be, but again, just to put that figure into context, so this was a special fund. It was outside of the debt break, 100 billion euros worth of spending on military defense. I spoke to the top general of Germany. He referred to this as beginning to fill the potholes for the German military. This is not going all the way in terms of what is required and the scale of it. There is a real question here, Tom, and I think it's something we've seen within the industry. We've done a lot of reporting on it. There are defense companies that are absorbing full teams from the auto sector, taking factories from other traditional commercial industry in order to build out, German defense. The question is, can the sort of Leopard tank be the new Volkswagen Beetle for the German economy? Probably not in terms of that scale, but that is certainly going to be one of the sort of stopgaps here, and something that we're going to be talking about in Germany, because that money needs to be spent.
Well, you talk about radical and rewiring the industrial base with the auto sector at its heart to better provide the hardware for military defence capabilities would be a radical move, wouldn't it? The industrial base is there, but you'd have to completely rewire it. So this is something that is being debated, it's being thought about, obviously, and it does seem, as Ollie has suggested, there is a huge gap in the needs around the defence spend of Germany, but it does seem amongst the leading candidates there an appetite to move at least gradually, but will gradually be enough.
Will gradually be enough. We'll, of course, maybe get a little bit of that answer gradually and in pieces as well. Bloomberg's Oliver Crook, of course, our German correspondent, joining us for a little bit of the breakdown. Tom Mackenzie isn't going anywhere. He's sticking around for our next conversation because we're going to get a little bit more insight into the auto story that we were just discussing. Donald Trump saying he's preparing to impose tariffs on cars, chips, and pharmaceutical imports of around 25% as early as April 2nd. Now, to talk more about that, cars, and the impact on Germany, we're joined by Dirk Wohlschläger. I'm going to get that right. Director of the Center for Automotive Research and, of course, a former executive over at IBM. Dirk, a pleasure to have you on the program. We were just talking about this. Is addressing the problem enough? Does the pace matter? Is slow and gradual from whoever is the new chancellor of Germany enough to rescue the German auto sector?
Yeah, morning, Kriti. I can only underline what Tom and Oliver already said. What we need are clear guidelines here in Germany, and what we are seeing right now, the positions of the party during the on these selected issues about the ban of the traditional combustion engines or the subsidies for electric vehicles are quite different. That's a nightmare for the industry and also for the consumers.
And what sort of response would you like to see from Europe when it comes to Trump's threat of 25% tariffs on autos, expected as soon as April the 2nd, Dirk?
Yeah, I think personally we must be honest about this. So at the moment, the tariffs on US vehicles into the EU are higher than the tariffs on European vehicles imported to the US. EU imposes 10%, and whereas the US so far charged 2.5%. So I think, first of all, the tariff should be equalized. And that's, for me, the typical Trump pattern to starting a discussion with a high number and finding a deal. So, it's only I think right way forward here to restructure the tariffs on both sides.
Dirk, what is the preference among, good morning from Berlin, what is the preference among the automakers of Germany as to whether or not the focus should be on going further and faster on supporting the transition to electric vehicles with subsidies, with that state support, or whether indeed to put a stop to that and go back to the combustion engine given the slowdown in EV sales we've seen?
Yeah, Tom, I think there is a different position by OEM, because it depends on their strength. We have some who are struggling and some like BMW who are very successful also in the EV market, and they are promising technology openness. You can get the 5 Series with different type of powertrain solutions. I think that there's not a common picture on the OEM side. But I think for the suppliers, this is even more important because they invested billions billions in new plants, new assembly lines, and overall, this have been around 250 billion euros so far in zero emission technologies across the EU. So from that perspective, I think we have already passed the turning point that we should go back and try to do something different.
Dirk, I've heard Germany's auto sector in 2024/2025 described as the equivalent of Detroit in the 1970s, and that the only real solution to an auto sector kind of recovery is something like a TARP-esque bailout. Is that what we need here? Is the solution to bringing back Germany's auto sector into full glory more spending and subsidies from the German government, which I should add they can't really afford at the moment, but is that the solution that will ultimately bring back and rescue the likes of Volkswagen, Mercedes, etc.?
No, I personally don't think that subsidies are the right way forward. I mean, when you launch a new technology like e-vehicles, I mean, then it makes sense. We have seen this in Norway, who spent subsidies or granted subsidies over years, and now they are selling 90% of all vehicles with an electric powertrain. So from that perspective, I think that's the right way forward. But in a continuous running industry, I mean, in particular with the challenge of the Chinese manufacturers, we have to focus on our structural cost and also on faster development times. That's what the Chinese are showing us, and also as in traditional markets. And I think this was also the case in Detroit decades ago. I think they lost the customer centricity, and Chinese, for example, are focusing and demanding much more features in digital features. So and Germans rather build traditional vehicles. I mean, they did a lot, invested a lot in digitalization, but these efforts needs to be supported in a much higher way.
Well, Dirk, you mentioned what we're learning from the Chinese here, and really that kind of idea of overcapacity we know has been plaguing Germany for quite some time. But isn't there also another lesson to be learned here, which is simply diversification of audience? We know Americans don't really buy German cars, but we know that Europeans and the Chinese, for example, have targeted both the European economy and the American economy, not to mention other parts of Asia as well. Do German car makers, I'll broaden this out to European car makers, need to be targeting different parts of the world, and how do they do that?
Yeah, that's exactly the case. And you are totally right, Kriti. That's where they are focusing on now, and the best word behind is the software-defined vehicle. So if you have a different architecture in the vehicle, you can build the same car, and the digital services you provide to the customers are depending on the market based on their demands. So what the Germans did in the past, we built the best physical vehicles. I mean, when you go with a Porsche or BMW, Mercedes on a racetrack, I mean, it's phenomenal the performance of the car. But that's not what the people desire in many markets. In particular, as I said, in the largest market in China, and I lived there for 2 years with my family, it's totally different what they are demanding from a car.
Dirk, you've also worked across defence as well as automotives in your career. I wonder, would it not be wise for the next German Chancellor, whoever it may be, to kind of shift the focus of German industrial policy from cars to defence, to dodge the tariff threat and please Donald Trump when it comes to European defence spending?
Yeah, I'm not an expert in defense that way, but I think what we finally need is a clear guidelines and really this in the transition. I mean, under no circumstances, the word what the Chancellor candidate Merz is using often, this technology openness. Under no circumstances this should mean that we now discussing all over again what is the right way. to achieve the climate targets. I mean that would bring us in a very, very critical situation. So certainly we have to adapt some regulations. So I personally think that the 2030 ban of realistic when we look on the numbers of EVs in the market so far and the current growth numbers of EVs, then we will not make the target 2030. So from that perspective, I think we need a target rather on 2035, which was also mentioned by some CEOs in Europe. But I mean, these are clear guidelines, and that's what the industry needs now, and not a complete new discussion.
Okay, clear guidelines. Dirk, before we let you go, going back to the tariff question then, and you see maybe 10% equalization across the tariff story, 10% in Europe, 10% in the US. But if we get more than that, if we get that 10% or even up to 25%, as Trump has suggested, what will that mean for the margin squeeze on automakers in Germany that are also, of course, already, as we've detailed, under that pressure? Do they absorb that? Can they pass that on pricing? What does that do to the earnings story for autos?
That's very difficult to answer, because what you said, Tom, and in your discussion with Oliver, I mean, the largest BMW plant is in the US. Mercedes-Benz is producing the SUVs in the US, in Alabama, and shipping these cars to China and to Europe. So I think it's a very complex environment. And it's not easy to drill it down on the margins in an easy way.
Dirk Vollschläger, really great to hone on, to get some of your knowledge, your experience. Thank you so much. Director of the Centre for Automotive Research, and Bloomberg's Tom Mackenzie, of course, on the ground for us in Germany as we head towards the election. And just a reminder, we're going to bring you all the news, the analysis, the market moves as we get towards those German elections, including a special programme when the polls close on February the 23rd, live from Berlin. So you don't want to miss that.
Absolutely. In the meantime, as we do have that countdown, we have our eyes on several of the earnings stories. Philips, for example, one of the worst performing stocks on the Stock 600 today. The CEO telling Bloomberg that the performance in China is partly to blame. We're going to dive into the details next. This is Bloomberg. A quick check on the stocks. Philips is the worst performer in the Stock 600 this morning, reporting that lower demand in China will continue to hold back growth this year. Philips CEO Roy Jacobs shared more on the outlook on the back of those results. Take a listen.
We see the momentum continuing that we had in the second part of 2024. And that was indeed slow consumer demand, and we saw still slow procurement in the healthcare side. Now, we also know that China is working its way back into economic growth, as well as we know that they're working through the reforms in healthcare. So we expect it will come back. We just don't know exactly when it's going to happen. So therefore, we are not running ahead of that timing, but it will come back at a certain point in time. Now, in the meanwhile, we are dialing up the engine and indeed deliver the innovations to the rest of the world. As I mentioned, we're next to North America. Also, there are good growth engines in Saudi, in Indonesia. We also see pockets of Europe where actually growth is coming back. So there are other areas we will go after the growth. And we have been really strengthening our fundamentals. So we've been launching exciting innovation, AI fueled, that will help us to deliver the growth and also deliver in China local for local products when the demand turns back.
How big is the China market for Philips now?
Around 10% of our total revenue. So it's still sizable. And we also expect that to continue. But we have also the other 90% to play for. And that's a great combination of different markets. Latin America, for example, was a great positive story last year. They had a few challenging years before that. They came back strongly. So we see the CapEx environments in general strengthening across the world. We saw that in the US, where they came out of a negative 22 for the hospitals. 23 was already stronger. And now in 24, we saw that really picking up, and therefore they're investing more because the queues in healthcare are still big. The need for healthcare is growing, and therefore we also expect that demand for our innovations that are really relevant for them will continue to be there.
Philips CEO Roy Jacobs speaking to our very own Tom Mackenzie earlier today. Lizzy.
Well, let's go from the earnings picture to the economics that we started the show with. UK inflation climbing to the highest level in 10 months in January. It was boosted by airfares, motor fuel, food and the imposition of VAT on private school fees. We can get more now from Dan Hansen, our chief UK economist at Bloomberg Economics. Dan, the headline inflation level slightly above expectations, only just. Services below expectations, but barely any market reaction here. The pound flat against the dollar and the euro. Do you read that as because the numbers are pretty much in line, or because traders think that the Bank of England isn't so bothered about inflation, it's more bothered about growth?
Yeah, I mean, I think it's probably a little bit of both. I mean, when the numbers dropped, I think the thing that struck me was services inflation. Core inflation was steady, in line with expectations. Core services inflation was a little bit below expectations and also below the Bank of England's forecast, so that's really important. I mean, if we look at what surprised today, I think it was food inflation, certainly relative to our forecast, relative to the Bank of England's forecast. I can't speak for other forecasters, but that was the area where we got a bit of a surprise. Traditionally, that's something that the Bank of England will look through, a bit like energy prices as well. So I think taking it as a whole, the bank is probably going to be pretty unmoved about how it thinks about this. It's just going to be continuing on this gradual path. And the key thing to watch will be services inflation, as I say. If that continues to trend down, I think that will give the bank space to continue easing policy.
What's the worst case scenario here? Is it ultimately just stagflation? Is that where we're headed?
I'm not sure that's where we're headed, but you're right. For the Bank of England, at least, it's an awful scenario where we have flatlining growth, inflation. It thinks is going to peak at 3.7%, but we could get something more than that, potentially if we get a spike in energy prices or the like. So, yeah, of course, for a policymaker, that is the worst-case scenario, but it's not our base case. We think growth is going to pick up. Signs yesterday that the labour market may be stabilising, albeit at a less hot level than it was at least about a year ago. So I think that isn't the base case, but yes, you're right, that would be a bad scenario, particularly when it comes to the Bank of England's thinking and interest rates.
That's certainly something we're going to be keeping a very, very close eye on. Those yields very kind of unchanged. Not much reaction in the pound either as we speak about that UK CPI story. Dan Hansen, chief UK economist for Bloomberg Economics. That does it for the opening trade. A quick check on these markets before I say goodbye. Underperformance in the FTSE 100 seems to be the theme this morning. Outperformance in the DAX, and that's important. A lot of that remains in that defense trade that is continuing. We are 3-4 days away from the German election. That is going to be crucial in terms of whether or not we see some sort of bigger reaction, perhaps, in the debt markets of Germany, and perhaps creating a little bit of fund flow into the gilt space as well. Right now, though, Germany, your outperformer, having its moment in the sun. Does it sustain? That does it for the opening trade. The Pulse is up next. You've got me. We're going to dive into more of these markets, more of the politics, an interesting conversation about AI you do not want to miss. Stick with us. This is Bloomberg.